Amazon is the second largest position in my portfolio for various reasons. Reason number one, I bought it at the end of 2018. Remember, at the end of 2018, we also had that panic in the stock market because of trade war with China. And if you don't remember it, then all the panic and all the issues that are happening right now in the stock market, the volatility, shouldn't really worry you either. Because a couple of years from now, you wouldn't remember what has happened in February or in March of 2025. So, okay, since then, stock went up, quite happy, of course. I added to that position because, well, Amazon, in my eyes, is one of the best companies ever created. So, makes sense to have it. Doesn't matter if stock market goes up, stock market goes down, economy is bad. I think Amazon as a business will continue to do very, very well. And as they've proven, this is a company that expands its total addressable market every couple of years. And I'll show you exactly why. So, under $200, is it a no-brainer? Yes or no? In my eyes, yes. What do you think? Let me know down in the comment section below. Hit all the buttons, like, subscribe. Would really appreciate that. We're trying to reach 90,000 subscribers. So if you're new here, push the button. Please push the button. Thank you very much. And if you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, Amazon. Right now, at $193.5 per share, a market cap just over $2 trillion. Now, in the last 3 years, Amazon stock has seen huge drawdowns, right? We've seen the stock go down 40% a couple of times and even 51%. More recently, especially year to date, stock is down around 20%. Year on year, about the same. That's the big drawdown right now. Actually, year on year, the stock is up 8.6%, but throughout the last 12 months, we've had drawdowns 15% or so. Now, what's interesting with Amazon is that if you always looked at Amazon just from a forward PE or just from a PE perspective, you probably would have never bought that business. And that's a big mistake that investors make. That's basically just looking at the PE and thinking that the stock is cheap or expensive. For example, at the moment, PE for the trailing 12 months sits at 35.4 times. The next 12 months, so a forward PE of 30.8 times. So cheaper as a forward PE than as a trailing 12 months. If we look at revenue growth for the next 2 years, it's expected to grow at a compound annual growth rate of around 10%. EPS growing much faster than that, 17.1%. Currently, the average analyst price target sits 36% higher than the price we're at right now. And if we look at the forward earnings, forward earnings, just what we've seen, 30.6 times. If we look at the 5-year mean, that's set at 64.4 times. So throughout all of these years, traditional investors, right, value investors would look at the PE and say, oh, forget about it. I'm not going to buy it because, well, PE is just too high. But if you actually understood the business, you looked at the business, you looked at operating cash flow, for example, you understood that the core business is actually pretty profitable. And it was only a matter of time until Amazon showed us how profitable they are. And that's why you're seeing this forward PE come down quite rapidly. Even if we look at some other metrics, EV to EBIT in the last close to 10 years or so, it's, I would say, the cheapest it has been. So yeah, imagine a $2 trillion company, and today the cheapest it has been, yet it's still growing. Revenue, so top line, around 10% or so, and EPS actually growing 70% faster than that, around 17.1%. So yeah, an amazing business that is getting cheaper and cheaper while becoming better and better. Perfect mix, in my opinion. Of course, shouldn't expect another 10x from Amazon, no, but market-beating performance, I think so. If we look at free cash flow growth for the coming fiscal years, right now, fiscal 25, the expected growth rate for free cash flow is 53.5%, followed by another 45% year-over-year growth, and then another 47.1% year-over-year growth in fiscal 2027 to reach $108.9 billion in free cash flow. Remember this number because we're going to do a reverse DCF later down in this video. If we look at one of the most amazing businesses out there, so AWS operating income, look at what has happened in the last 10 years. This thing has grown at a compound annual growth rate of 56.2%. Remember, early days when they launched AWS, this was of course, money-losing business. They asked Jeff Bezos, does it make sense? Well, he basically said, look, we have the luxury of being a long-term vision company. So yeah, in the meantime, we might lose some money, but since we are thinking longer term, we think this is worth our while, and well, it's worth their while and then some. If we look at what has happened with operating margin for AWS, look at that huge rebound since the bottom here in June 2023. Went from 25% and last quarter the number was 37% operating margin for a business like AWS, which is at an annual revenue run rate of over $100 billion. Now, like I said at the start, Amazon is a company that can expand its total addressable market, as they've shown us in the last decade plus. I mean, actually since the start of this company, right? You start selling books and now you might be selling cars online, by the way. So look at what they've done. You've got the online stores, which of course is a big chunk, yeah, for sure. But then they added third-party seller services, advertising, subscription. Of course, there's physical stores there as well. And the big one, AWS. Who's to say they're not going to add other segments of their business in the future? I mean, we've talked about One Medical, the medical side of things that could or could not compete directly with a HIMSS. I mean, they could do technically whatever they want. That's how powerful Amazon is. If we look at one of the fastest growing segments, excluding AWS, the ones that also have higher margins than the core one, the online stores, look at this, subscription. Subscription, since they reported it, it has grown at a compound annual growth rate of 32%. Advertising, that has grown at a compound annual growth rate of 34.8%. Third-party seller services, grown at a compound annual growth rate of 29.5%. So here again, just proving that Amazon is just one of the best businesses ever created. And even at the size they're at right now, even at the valuation they're at right now, in my opinion, this is a no-brainer. Quickly doing a reverse DCF here, we plugged in the trailing 12 months free cash flow, terminal growth rate, discount rate, and dilution at 3%. We can see that to justify today's price, approximately, it will have to grow free cash flow each and every year for the next 10 years by 19.3%. Now, that number might seem quite high, but as we've seen in the next 3 fiscal years, including this one, it's expected to grow 53, 44, 45, 47%. So is this number too crazy? I don't think so. I think this gives us a nice little margin of safety here, because remember, the number that we've got, again, projected numbers, is what, around $108 billion in free cash flow by fiscal year 2027. So 3 fiscal years later. Here we are getting closer to that number between years 6 and 7. So yeah, in my opinion, it is a no-brainer under $200. Now, of course, I know that under $200 might mean 180, 160, 170, 150, etc., etc. Yes, I understand that, but I also mean under $200, meaning also at today's prices. Could it go lower? Yeah, it could go lower. It did actually go just under $190 this week, but we've seen some buying activity. It's been in a downtrend for the last month and a half or so, and it's also under the 200-day moving average, so a bit in no man's land. But then again, short-term things, I don't really mind adding more, even if it is the number 2 position in my core portfolio. What about you? Have you been adding to Amazon? It's too big for you. What do you think about the company under $200 at the moment? Buy, hold, no-brainer? Let me know down in the comment section below. If you enjoy this type of videos, hit all the buttons. We really appreciate that, and we'll see you in the next one. Bye-bye.